Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey guys, Chris and Jason here with the Private Lenders Podcast. Thanks for being with us today. We're going to be discussing some old school loan underwriting, the 4 C's of underwriting. That in 1 second. Quick announcement that we have 2 spots left for our November 3rd and 4th Inner Circle meeting. Private lenders from around the country here in Maryland, about a month from now. So if you're interested, go check out Hard Money Mastermind innercircle.com to apply, and we hope to see you here in November. Okay, let's dive in. 4 C's of underwriting, in case you're not familiar. You got collateral, capacity, credit, and character. And they all are important, some more than others. And getting used to what you're looking at in terms of the 4 C's is going to predict a lot about how the loan and the deal are going to play out.
Yeah. I think a lot of people have gotten away from the basics over the last few years because they were just kind of out there struggling, trying to find deals and putting deals together. And we're at an interesting time right now. You know, there's an argument that the market may be changing. Maybe it will, maybe it won't. Maybe it'll happen soon. Maybe it'll happen later, whatever the case is. But no matter what the market is, you still got to stick to your underwriting model, no matter what. Just because other lenders are giving 100% financing or cheaper rates or higher leverage, that doesn't matter. You're raising capital from other investors. Maybe you're lending some of your own money as well, which is obviously the game plan. But you gotta stick to that. Got to stick to that model, because think about it. Over the last few years, 10 years, you could have done bad deals and they still could have performed, just because the market made them perform. Property values have continuing to gone up and up and up and up, but that's not going to be forever. So if you follow the right model and you're underwriting these deals correctly all the time, and you're being conservative, you'll have a lot less risk on some of these deals. And, just because stuff worked in the past doesn't mean it's necessarily going to work in the future. And, unfortunately, kind of at startup time, it's hard to do that sometimes, because you don't want to lose out on an opportunity. You don't want to lose out on a good opportunity, but sometimes you have to if you're not making a wise underwriting decision. So let's start with collateral, the first C. Obviously, collateral is the most important thing. If the property is not good, that you have a first mortgage against or first deed of trust against, there's no point of going any further. It has to be a good collateral piece of property. Typically, you want to be in at 65 cents on the dollar. You want to have 35% equity cushion at any given time, because that'll give you the ability, if the loan defaults, in order to collect either through a foreclosure or a judgment. We know from experience that 35% equity cushion is the correct equity cushion, right? There's lots of good deals that we've done in the past that have defaulted. And if we didn't have 35% equity cushion, we, wouldn't have got all of our money back on that particular deal. So this isn't like a made up thing. Oh, well, maybe I'll push it to 70% or 75%. It's a good borrower. That 35% equity cushion is really where you need to be at.
Yeah, and I think the industry has probably gotten a little bit lazy on that with the appreciating market that you mentioned before, which has started to change right now. So over the past, 13, 14 years of an appreciating market, lenders' LTVs were going up, especially the institutional backed people, and they're pushing that up to 75, maybe up to 80% of the ARV. Like 10% down of the purchase price and then 100% financing on the construction. You just can't do that in a changing market. And people are starting to realize that now. And I think that lenders who control their own capital likely have been more responsible in their lending because, well, like I said, they're, controlling their own capital and responsible for the performance of the loan portfolio. It's not like you're just selling a loan and it's someone else's problem now, So, and that's what in our mastermind group and in our company, that's what everyone's doing and looking at and being careful about. So yeah, it'll be interesting to see how a lot of the industry adjusts that first C, the collateral position, as we're going into a changing market.
And you have to have discipline. You got to say no. I mean, your good borrowers and good clients that you've done deals with, they're going to push you because they're going to want to get higher leverage. So they need less cash out of pocket, and you got to stick to your guns. You've probably heard the story about one of the groups that we lent over 100 loans to over the years. We haven't done a loan for them in the last 5 years, right? We could have, if we wanted to come down on price and go up on LTV, right? Go up on leverage to them. Not something we were willing to do. Mm-mm. We had to be strong and obviously go out and find new opportunities because you can't compromise. You cannot compromise on that. It's important. So number 2 is character. So we're going in order of what we believe out of experience is the most important. They're all very important, but character is very, very important. If your borrower doesn't have good characteristics like communication, that's a big one. If you're having a hard time communicating with the borrower when he wants something or he or she wants something from you, like money for a loan, how hard is it going to be to communicate with them if you want something from them, like money for a monthly payment or a repayment schedule or something like that? I mean, the characteristics of the borrower, if you have a good loan, like a good property, and a bad borrower, like that deal will not perform. A bad borrower will bring down a good deal, and a good borrower typically will bring up a potential okay deal.
Absolutely. I was also thinking about that relating to, so we're always, we tend to close quickly. That's part of how our company has always stood out. And in that process, you need things from the borrower, their own entity documents, their own, property insurance, like all the normal stuff that goes into a loan file. And you need stuff from them. And watching how they operate leading up to a loan closing is going to tell you a lot about their character and how they're going to operate after the loan is closed and it's construction time, for example, right? Are they organized? Do they have their stuff together? Are they responsive in getting back to you? And it's going to tell you a lot about how they're going to operate after closing happens, right? Character is huge. And especially like Jason said, once, the loan's outstanding, they need to do that construction work. They need to make payments on time. People operate very differently. And you start being able to see the future a little bit based on going through these experiences over and over and having, done a lot of loans. But yeah, character is huge. Character is absolutely huge.
So after that, the third C is capacity. Does the borrower have the capacity, the ability to come to the table with the down payment, make the monthly payments, execute on the construction project, repay the loan, things like that? Those are all part of capacity if they're able to perform on this project. And again, you might have a good deal, but the borrower might not have, the ability to do it, right? They might not have the wherewithal to run $100,000 construction project, right? So that's something that's important. They might, the cash, let's say their down payment, let's say they have a down payment of $60,000. That's what their cash to close is. And they only have $80,000 to their name. Like they only have $20,000 buffer. Is that going to be enough? We all know that construction projects always go over budget and they always go over a timeline, right? So what happens, and a big thing that we always check for is to make sure the borrower has enough liquidity that if a deal starts going sideways, they have means to, to finish it up. Right? Can they come in and finish up the project if it goes under budget? So that being said, that doesn't necessarily mean that you don't lend to a newer real estate investor that doesn't have experience. That just means that you need to check a few additional boxes to make sure they have the wherewithal to complete the project, make the monthly payments. Obviously, if a borrower doesn't have good credit, you can't do a loan for them where it's a buy, fix, and rent out because there's no exit strategy. If a borrower has lower credit, unfortunately, their only exit strategy is to resell because a bank's not going to give them money to do a refinance.
Yeah, we saw a situation recently. In capacity, you could really call it cash too, I guess, if you wanted. I mean, that's the largest aspect of the capacity C.
Yeah.
And we saw a situation recently. We had a loan that we had quoted for a borrower that seemed okay, maybe a little iffy, but we quoted accordingly. Property with a lot of value in DC, and They didn't end up coming with the cash. Like they needed over 100 grand. I don't remember exactly what the number was to close.
200.
Maybe it was 200. Okay.
It was like 200 on a $400,000 loan.
Okay. They didn't have the cash. They delayed settlement. They were trying to get it from here and there. They're raising money, whatever. Didn't happen. And the deal fell through. And then the same property coincidentally got picked up by another buyer and brought back to our company for financing. And we're about to close that loan on the same property with a borrower that does have the capacity. Right. So,
and it's funny that new borrower had the capacity. He also had better credit. And he also got the deal at a better number, right? Because he had better characteristics, right? Like there was a lot of things that made the transaction better just by inserting a better operator.
Yep.
So that's interesting. So the fourth C is obviously credit. Credit isn't everything, but it certainly tells a story. I mean, statistically, anytime we've done loans with borrowers with lower credit scores and it's a big construction project, they typically run into problems. If somebody mismanages their personal funds and their credit and their bills, chances are they're probably going to mismanage a construction project. That's just what it is. Now, again, credit isn't the only determining factor. It's not the most important determining factor, but sometimes it does tell a story. So it's something to consider. If you're not currently pulling credit inside your business, you should, as a lender, you should pull credit because typically it tells a story. And there's a story behind that story, right? So if the borrower's credit's not great, get on the phone with them, have a conversation and figure out what it was. I went through a divorce, or there was a sickness in my family, or, I bought this property in 2007 and it went down by 50% and I walked away from it, whatever it is, right? Figure out if the story kind of makes sense with the current situation.
Yeah, you can see a lot by reading someone's credit report, how they operate basically in life, right? Like, do they own a home? Do they have a mortgage on there, right? Do they have a reasonable car payment? Do they carry very high balances in credit cards? Or do they just not pay any of their bills? Do they have lates all the way down the report? Because if that's the case, they're not going to pay you either. They're not going to pay us. They don't pay their stuff. Is it a situation like they had one thing they missed, like a medical collection that just got, went into the mail and whatever, and they have a $1,500 medical collection, which is no big deal, but it's dropping their score by 80 points, right? Like that would be a situation where you would say, okay, that's an isolated incident. It was a mistake, yet it'll hit their score, So it's not only the score that matters, it's the trade line history and what you can see in there and the public record stuff too. Like, do they have a foreclosure in the past, bankruptcy? Like these are all things you learn a lot about somebody's adult life by reading a credit report.
Yeah, that's a good point because, we recently were reviewing a deal and the borrower had pretty good credit. But over the last year, they haven't made a payment and they're in a humongous financial crisis. And, they kind of came to us. They were sinking ship and they kind of came to us for, a life vest. This was a property that they owned free and clear. And they're trying to just liquidate assets and refinance assets. And, their credit score was good because they had, decades and decades of good credit. But over the last year, the credit was still like upper sixes, lower sevens but the last year you could see it's like, hey, they've got it behind on everything. What's the story? Do we want to be involved with this particular situation if there's a sinking ship and they're and where they're last out? Right, in order to help on the transaction, is that a good investment decision for us to make? So, point being is all four C's are important. You got to understand them all, and you got to as you're underwriting, you have to underwrite for all of them. It's not, you can't go into this as like, oh hey, this borrower is buying a good deal, and they're willing to put down 10%, and they'll pay my terms. I'm going to proceed. You got to go through this whole thing. If you're a newer real estate investor, if you're a newer hard money lender or private lender, deploying your own money or someone else's money, make sure you meet every borrower. Go out to all their properties. You'll learn a lot from them. I mean, we encourage at least newer lenders to only lend in their local markets and the markets they know really well. They have, they can be the local boots on the ground for that. And as you grow and as you expand, you'll know from experience how things change. But all these things are very very important.
Absolutely. Yep. Good stuff. Thanks for checking out the podcast on underwriting. Some people might not find it to be the the sexiest topic in the world of private lending, but it's the most important at the end of the day. So yeah, like I started with at the beginning, if you guys are interested in coming here and working with us in Maryland, check out Hard Money Mastermind, innercircle.com, and we'll see you next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private